I think silver is in that early stage. We just blew through 30, which was resistance for many years, which is now relative support. And I think any dip below 30 is an excellent buying opportunity. And I wouldn't press my luck looking for 28 or 27. I think the time to buy those prices has passed. I was trying to get people to buy silver when it was under 25. But if you didn't buy it when it was under 25, you could still buy it now under 30. 30 is still a big pullback from 50. 50 is where silver got in 2011. And that's where it got in 1980, right? The Fed, of course, hasn't cut yet, but it's a foregone conclusion that they're going to cut. So the only question is, how soon do they cut? Not, are they going to raise rates? So all this is bullish. None of these central banks is going to do what it takes to bring inflation back down to 2%. They're just not admitting that yet. So they're all trying to pretend that they still have a 2% inflation target and that they're committed to hitting that target. But at the same time, they're easing, they're cutting rates, or they're talking about cutting rates. So their rhetoric, their deeds don't match their rhetoric. They're talking the talk, but they're not walking the walk. And so pay attention to what they're doing, not what they're saying. So if they're trying to misdirect you with their rhetoric and they're talking about how we're committed to lower inflation on the one hand, but then they're cutting rates, even though inflation is not anywhere near 2%. Now, what are they saying? Well, we just assume that inflation is going to keep falling, and so we can start easing. Well, why didn't they make that assumption when they had rates at zero or negative and inflation was still below 2%? Why didn't they say, we've printed a lot of money, we've kept interest rates low for a long time, even though inflation is still below 2%, we're going to start hiking now because it's clear that inflation is going to go up, right? It's going to trend higher based on what's in the pipeline. No, they said we need to wait. And in fact, with the Federal Reserve, not only did they wait for inflation to be 2%, they said we want it to be above 2%. We want to make so sure that we are at 2% that we're not going to stop at 2%. That's when they introduced the concept, too, of inflation averaging. They wanted to make up for the years of sub 2% inflation with some years of above 2% inflation. But also, they said they wanted to make sure that the move above 2% stuck, that it wasn't like a fluke, like we didn't go back above 2%, then come right back down. So they wanted to make real sure. They wanted to stay easier for longer just to make sure that inflation got to 2%. Well, why don't they want to do the same thing now when it's way above 2%? Why are they already assuming that an inflation rate that's 3% or 4% is going to go down to 2%, and so therefore they can start cutting in anticipation of that, right? They don't want to wait to see the whites of the eyes like they did before. They didn't want to anticipate. And in real time, right, I criticized the Fed for what it was saying because prior central banks had always said you can't wait. You can't wait to see the whites of inflation's eyes before firing. You got to anticipate, right? You can't let the inflation genie out of the bottle. That if you wait for inflation to manifest itself, if you let that genie out of the bottle, it is very hard to put it back in. And so therefore you want to err on restraint. So what the Fed should have done, what the ECB should have done, if they really cared about keeping inflation contained at 2%, they should have acted preemptively. But they all said, no, we can't afford to do that. We don't want to take any actions that might unnecessarily harm the economy when we don't have any proof that inflation is 2%. So let's actually wait for the genie to get out of the bottle, and then we'll put it.
Peter Schiff continues his analysis by delving deeper into the implications of central bank policies on the gold market and investor behavior. He argues that recent actions by central banks and market dynamics have created a challenging environment for both new and seasoned investors in precious metals. Schiff emphasizes that understanding these dynamics is crucial for making informed investment decisions. Schiff highlights that central banks, particularly the Federal Reserve, have been sending mixed signals to the market. While they claim to be committed to reducing inflation, their actions suggest otherwise. This inconsistency creates uncertainty and volatility in the market, which can have a significant impact on investor sentiment. He points out that many investors have become bearish on gold due to recent market fluctuations, which is likely what strategic players like China want. China's announcement of a temporary halt in gold purchases may have been designed to shake out weak hands from the market. Schiff suggests that this move was intended to create a buying opportunity for China by driving down prices temporarily. As new and inexperienced investors panic and sell their gold holdings, the market experiences a temporary dip, allowing larger players to accumulate gold at lower prices. This strategy highlights the importance of understanding the motivations behind market moves and not being swayed by short-term fluctuations. Schiff also addresses the broader implications of central bank policies on the gold market. He argues that the central bank's reluctance to raise interest rates and their inclination to ease monetary policy despite high inflation are bullish for gold. In an environment where inflation is rising and real interest rates remain low or negative, gold becomes an attractive investment as a hedge against inflation and currency devaluation. Furthermore, Schiff discusses the psychological impact of market volatility on investors. He notes that recent sell-offs in gold may have discouraged new investors who entered the market during the recent rally. These investors, having experienced losses, may be reluctant to re-enter the market, waiting for more significant dips that may never come. This behavior, he argues, benefits long-term investors who remain committed to their positions, as they are better positioned to capitalize on future market rallies. Schiff emphasizes the importance of maintaining a long-term perspective when investing in gold. He argues that while short-term market fluctuations can be discouraging, the fundamental factors driving gold's value remain strong. Central banks' ongoing monetary easing, high inflation, and geopolitical uncertainties all point to a favorable environment for gold in the long term. Investors who focus on these fundamentals rather than short-term market movements are more likely to achieve their investment goals. In addition to central bank policies, Schiff discusses the role of market sentiment in driving gold prices. He notes that periods of market volatility can create opportunities for astute investors to accumulate gold at attractive prices. He advises investors to stay informed about the broader economic context and to be wary of letting short-term market movements dictate their investment decisions. Schiff also addresses the potential for further market volatility in the coming weeks. He notes that upcoming events, such as the Federal Open Market Committee (FOMC) meeting, could have a significant impact on gold prices. While the Fed is unlikely to cut rates immediately, their statements and actions will be closely watched by the market. Schiff advises investors to pay attention to the Fed's actions rather than their rhetoric, as this will provide a clearer indication of future monetary policy trends. In conclusion, Schiff provides a comprehensive analysis of the current state of the gold market and the broader economic context. He highlights the inconsistencies in central bank policies, the strategic actions of major players like China, and the psychological impact of market volatility on investors. Schiff emphasizes the importance of maintaining a long-term perspective and focusing on fundamental factors when investing in gold. His insights underscore the need for investors to stay informed and be prepared for potential market volatility in the coming weeks.
I think Friday turned a lot of people who may have gotten bullish on gold in the last couple of weeks bearish. And that's probably exactly what the Chinese want, right? If the Chinese started this sell-off just by announcing a 1-month hiatus, from buying gold, and that was enough to get the new buyers to throw in the towel, well, now that's more gold for the Chinese to buy. And they got a lot of gold that they need to buy, and they want as little competition as possible. It shows you, what can happen. I don't know what it's going to take now, because so many people that maybe just bought into the market in the last week or two who are now gone, right, and just thrown up their hands in disgust, right? Who knows where they're going to come back in. I mean, maybe gold will have to be well above 2,500. Silver might have to be 35 or 40 before some of the people who just bought, right? Some people finally just saw the move up in silver and they bought in at maybe 31 or 32, and now they just sold out at 29. They took a loss and they said, that's it. It's over. I'm getting out. And maybe some people actually got short. They're going to be in for a world of hurt in this next rally. I read a lot of articles. A lot of people think that there's going to be a lot more selling coming. Next week we get the FOMC meeting. The Fed is not going to cut rates, obviously. And they're going to talk. I mean, most of these press conferences have been very bearish. Very dovish. And so we could see a big reaction in the gold market, in the foreign exchange market next week that completely reverses what happened this week. But you still have a lot of people that just assume that the sell-off that started on Friday is just going to continue. It may continue for a day. Maybe we go down again Monday or a little bit Tuesday. But again, this is going to be, I think, short and sweet. This is a huge bull market, and people are not going to have an opportunity to buy that big a dip. I think what we just saw is about all the opportunity you're going to get. But what these declines do is they're not enough to give the bulls a really great buying opportunity. They're just enough to scare the weak longs and to prevent other people who were considering getting into the market from taking a position because they get scared. And it probably emboldens the shorts, and it probably encourages people to enter the market from the short side. But you're not going to get a big enough dip for the longs, for the bulls, to get a really good sale. I think these are short and sweet opportunities, and most people will miss them because the market pulls back, and then you're hoping that, okay, maybe we'll get a bigger pullback. I don't want to buy just yet. And the next thing you know, the market's running off to new highs. So I wouldn't expect there to be much downside below where we are now. And again, as I said on a prior podcast, I think 30 for silver is what 2,000 was for gold. I think now that we've gone through 30 an ounce, 30 is really the support. Again, we could trade below it like we are now, 29.50, just like gold went below 2,000 many times before it went to 2,400 and hasn't got anywhere near 2,000 since. I think silver is in that early stage. We just blew through 30, which was resistance for many years, which is now relative support. And I think any dip below 30 is an excellent buying opportunity. And I wouldn't press my luck looking for 28 or 27. I think the time to buy those prices has passed. I was trying to get people to buy silver when it was under 25. But if you didn't buy it when it was under 25, you could still buy it now under 30. 30 is still a big pullback from 50. 50 is where silver got in 2011. And that's where it got in 1980, right?
Peter Schiff wraps up his analysis by discussing the broader implications of central bank policies and market dynamics on the global financial system and the future of gold and silver. He underscores that the Federal Reserve's and other central banks' actions, rather than their rhetoric, are crucial in understanding the direction of inflation and interest rates. Schiff notes that the Federal Reserve has not yet cut interest rates, but it is widely anticipated that they will. The real question is not if they will cut rates, but when. This anticipation alone is bullish for gold, as it signals that central banks are more concerned about stimulating the economy than controlling inflation. Schiff argues that no central bank will take the drastic measures necessary to bring inflation down to their nominal 2% target, as doing so would likely harm economic growth and stability. He points out the hypocrisy in the central bank's strategies. When inflation was below 2%, central banks, including the Fed, kept interest rates low and engaged in extensive quantitative easing, arguing that inflation needed to be higher. Now, with inflation well above 2%, they are still hesitant to take aggressive actions to curb it. Instead, they are already discussing rate cuts, assuming that inflation will naturally decline. Schiff criticizes this assumption, arguing that it reflects a fundamental misunderstanding of inflation dynamics. The inconsistency in the central bank's approach has significant implications for the global economy. By not addressing inflation head-on, central banks risk allowing it to become entrenched, making it much harder to control in the future. This scenario creates a favorable environment for gold, as investors seek assets that can preserve value amidst rising prices and currency devaluation. Schiff also highlights the role of China in the gold market. China's recent announcement of a hiatus from gold purchases led to a sell-off, which Schiff believes was a strategic move to drive down prices temporarily. This allowed China to buy more gold at lower prices, reducing competition from other investors. This tactic underscores the importance of understanding the motivations behind market moves and the need for a long-term investment perspective. He further explores the psychological impact of market volatility on investors. Many new investors who entered the gold market during its recent rise have been shaken out by the recent sell-off. These investors, having suffered losses, may be reluctant to re-enter the market, waiting for more significant dips that may never come. This behavior benefits long-term investors who remain committed to their positions and are better positioned to capitalize on future rallies. Schiff emphasizes that the current market conditions provide a unique opportunity for savvy investors. Despite short-term volatility, the fundamental drivers of gold and silver prices remain strong. Central banks' reluctance to tackle inflation aggressively, geopolitical uncertainties, and the ongoing de-dollarization efforts by countries like China and Russia all point to a bullish outlook for precious metals. He advises investors to focus on the long-term fundamentals rather than short-term market movements. The current economic environment, characterized by high debt levels, ongoing monetary easing, and geopolitical tensions, creates a favorable backdrop for gold and silver. These factors make precious metals an attractive investment for those looking to preserve wealth and hedge against economic uncertainty. Schiff also discusses the potential for further market volatility in the coming weeks, particularly in response to the Federal Open Market Committee, FOMC meetings, and other central bank actions. He notes that while the Fed may not cut rates immediately, their statements and actions will be closely watched by the market. Investors should pay attention to the actual policies implemented rather than the rhetoric, as this will provide a clearer indication of future monetary trends. In conclusion, Peter Schiff provides a thorough analysis of the current economic landscape, emphasizing the inconsistencies in central bank policies and their implications for the gold and silver markets. He highlights the strategic actions of major players like China and the psychological impact of market volatility on investors. Schiff underscores the importance of maintaining a long-term perspective and focusing on fundamental factors when investing in precious metals. His insights suggest that, despite short-term market fluctuations, the long-term outlook for gold and silver remains bullish. Investors should be prepared for potential volatility, but stay focused on the underlying economic trends that drive the value of these assets. If you want to stay most up-to-date on the silver and gold markets, make sure to subscribe to my daily 5-minute silver and gold newsletter. It provides the latest expert insights, breaking news, market trends, and investment strategies, all in a concise format. Click the first link in the description to join thousands of others and enhance your investment knowledge right now. If you enjoyed this video, please give it a thumbs up and subscribe to my channel. Your support helps me stay motivated to bring more valuable content to you. See you in the next video.